Hi everybody, it's Maynard, Mike, and Colin, and we're back for episode 2 here at Veriton of Close of Business Tuesday. We're really excited. We're always excited, but we're particularly excited today to have a great friend of our firm and just a good friend of energy, Howard Newman. Howard is the founder of Pinebrook. He was at Warburg Pincus for 22 years. He was an investment banker for 10 years before that. He's been on, I think, over 45 boards, many of them public. And so when we thought of today's changing energy world, we just got super excited to get our good friend Howard. So Howard, welcome. Thank you for joining.
Thank you, Maynard. Thank you for the invitation. I'm honored. Excited to be here.
Well, it's fun. We're also going to get into some nature-based solutions. Howard introduced us to the team at Salk, and so we're not going to let you get out of here without talking about that one too, Howard. But why don't we jump in, Mike? Never a dull moment. Some pretty unique stuff has been going on. We're, of course, all watching the Ukraine and all that stuff, but why don't you tell us what's going on in your world?
Yeah, I mean, today it's a really crazy market. Crude oil is down, energy stocks are down. The market's kind of flailing a little bit, but you know, we try to not look at it in one day. We try to look at it over the last week and over year to date. And right now, energy is is up about 25% year to date. The S&P is down about 5%. Over the last week, oil is about flattish, and energy stocks are about flattish. But if we want to go ahead and look at some slides here and give you an idea of what's been going on in the markets and what we anticipate is going to happen in the markets over the next week or so. You know, obviously we talked about the S&P performance. One of the things what we didn't talk about is some of the big moves outside of energy. As you saw, Facebook was down 30% last week. That was the equivalent of $270 billion in market cap getting wiped away. Biggest ever. That was the equivalent of Chevron. And the other side, you saw Amazon was up $170 billion. That was the equivalent of the size of Shell. Up. And the point is that is not what you like to see in a bull market. That is not an indicator of a bull market. So, you know, with rates going up here over the next year, it's something to key on. What we're going to see happen here in the next week is you're going to start to see some E&Ps are going to start to report earnings. Just like last quarter, it's all going to be about OFS inflation, capital discipline, what do cap budgets look like, and return of capital in the form of fixed dividends, variable dividends, and share buybacks. The other thing is on Thursday, we're going to see the CPI come out. It's going to be a big event. Expectations are for 7.3%. Last month was 7%, and so that's going to go a long way to determine whether the Fed's going to raise rates 25 or 50 basis points. You know, now what we're seeing today is not only in regards to the Ukraine, it looks like some of the stuff behind that is starting to cool off, but you're seeing Iran, we're meeting with them, others are meeting with them, and I think what's happened here is people probably a month, 2 months ago thought that there was not going to be any movement on sanctions, and it's starting to look like there might be some movements on sanctions in Iran's favor. They have spare capacity. If those barrels come on market, they'll obviously impact crude. You know, and bottom line, you know, we look at crude oil right now is very tight. Commodities are very backward dated. But the concern we have is you know, some oil strategies are out there basically talking about they've never seen markets this tight in 30 years in Goldman Sachs. And it seems like it's very consensus bullish that oil is going to continue to go up. And all we say is that it's getting a little bit too bullish for us. We could see a pullback here with some of these issues we just talked about. And so from that standpoint, I think you probably want to take a little bit of a cautionary tone, be looking to buy in a pullback. You know, now some of the things that we've seen over the, that we're looking at in the markets right now is BP basically reported today. And one of the things we saw in BP's earnings today is just some of the talk and transition. As you guys most know, BP has been ahead of really everybody else out there on the energy transition. And some of the stuff that came out of their call was very interesting. You know, if we look at the first line up there, it said, don't tackle demand, put off by the transition. Windfall tax. This is being talked about in the UK right now. The last time we saw something like this was 1980 with Carter. That didn't exactly inspire domestic production. And so the other thing we saw is oil prices could be much higher with accelerating transition. That is definitely not consensus. We've been led to believe over the last couple of years is the faster the transition, the faster we get away from crude oil, the lower prices will go, and that's just not happening yet. And so the reason like I said, I put it up there is because they're further along in transition. And the next slide is what has come out here in the last week. You saw BlackRock, Larry Fink put out his annual letter. He talked, was titled "The Power of Capitalism," and it's kind of fraying at the edges. So we don't want to go into everything here, but some of the things that we saw here is in the second paragraph is your purpose should be, you should be your North Star, and you should be engaged. Things should be inspired by you. You don't want to hear from us. And some of the things we're seeing from BlackRock is BlackRock just does not seem to be taking that method. They're basically going out there and telling these companies what they want them to do on energy transition. And I think, that's an interesting statement. And the other thing is they also, you reiterate what BP said is, you need to be honest that you might have higher costs today. And so, as you walk through these slides, they keep talking about an energy, affordable energy, fossil fuels. You need natural gas for transition. And so a lot of lines up here pretty much saying that these guys have been very, very vocal on, fossil fuels and getting away, and clean energy. They seem to be backing away as well. So you have one of the biggest oil companies furthest along in transition is backing away. You've seen one of the biggest the biggest fund managers out there seems to be backing away as well. And of course they are. And the reason they're doing that is because, oil prices have gone up significantly. Investors are underweight. Endowments, and a bunch of other people are underweight these names, and it's been the best performing sector over the last 12 to 18 months. And so the one last slide we go to is, we'd say this: ESG has been very topical. BlackRock's been pushing it pretty hardly. And it's, it means environmental, social, and governance. And maybe we need to rethink it about as ESG being energy supplies growth. This is what brings people out of poverty. This is probably what's best for society. So we just leave it at that.
It's a really interesting week. I was adding up all those B's as you were going through. We had bullishness out of the analytical sort of research commodity community, maybe too much, but at least very strong bullishness. And then we had BP backing off, maybe, and you have BlackRock backing off. So there's we're kind of, are we hitting the brakes? Colin, I know you've got some thoughts for us today on the oil market as well. What would you add?
Yeah. Hey, Maynard. Hey, Mike. Well, today I've got some slides on oil as an inflation hedge. And of course, one measure of inflation that we might look at is U.S. consumer price inflation, which you can see here in this line graph at the top right of this chart. A couple of observations. When we look at a long chart like this one, 60 years of data, we can see periods of rising inflation rates and falling inflation rates. Sometimes they're really big, sometimes they're smaller. We can see that inflation can come out of nowhere. And even when you think that you've got a handle on it, it can surprise you. Here you get these big, long oscillations. In the late 1980s, it was more of this jumpy kind of stuff. From 1966 to 1982, it persisted far longer than even experts in economic theory or practice might have predicted. From 1966 to 1982, we were in a very durable inflationary environment. Equities, public equities, essentially traded sideways for that entire 16-year period. Of course, more recently, inflation's been more absent. When we look at the chart, there's also one last point to make, and that is average inflation can mean different things at different times. In the 1970s, which has become the heuristic for talking about inflation, we had average CPI closer to 7%, about where we are today. Of course, since then, we've had numbers closer to 2 to 3%, which is what the Fed has been targeting more recently, but we can still have a concept of rising inflation or pressure on the margins of a business without getting to the extreme of these 10 or 12 or 14% numbers that we saw in the 1970s. So to answer the high-level question, whether oil is an effective hedge against inflation, what we've done simply is we've taken the Consumer Price Inflation Index in the United States, used it as a filter, ask the question on monthly asset returns on whether inflation is rising or falling sequentially in terms of the year-over-year inflation rate, and whether it's above or below its average for these four regimes that we specify. We then annualize the monthly returns and we see what happens. And what you can see here in these two by twos on the left for the S&P 500 and world equities, equities tend to do okay pretty much in all environments. They really don't like rising CPI, particularly when it's above average, but returns are flat to slightly down. Now, keep in mind, this is the average of the S&P 500. It's the average of world equities. So buyer beware on particular circumstances. But one can see that basically over the long run, if you're in a falling CPI environment, you'll have about 11 to 12% annualized expected and realized returns. And it's when you get into this quadrant of rising CPI above average that you begin to have problems. And that's the environment we're in right now, which is part of the reason why equities have been struggling so hard, particularly after having such a great, fantastic run for so long. Now cast your eye over to the right-hand side, and we get a different story when we look at crude oil futures and copper futures. Oil futures really do not like falling CPI environments. This is your classic up like an escalator, down like an elevator, boom bust cycle in commodities. But they really love rising CPI environments, particularly when it's above average CPI. Now, Milton Friedman famously quipped that inflation is always and everywhere a monetary phenomenon. Maybe we can talk a little bit about that with Mr. Newman, but basically what's happening here is you're getting a relationship where when equities are faltering, commodities tend to put in their best performance. Now, keep in mind, these are monthly annualized returns. So it may be the case that you're in one of these kind of sharp upswing oscillations like we saw in the 1970s, or maybe you're in one of these more jumpy kind of environments like we saw in 1988, 1989. It's debatable. Nobody knows how long these inflationary environments might last. The one we're in right now has come very swiftly, gotten to a very high level. It would not be weird at all to suddenly be in the falling CPI above average environment and have a month or two that's challenging for energy. On the left-hand side, you can see the producer price inflation index here. We're just looking at individual commodities and industries to illustrate the point that inflation has not been only about supply chains, particularly through international channels. You can see here the list of chemicals, carbon black, paints and coatings, iron and steel mill products, just really powerful inflationary impulses. One point I would make is oil and gas field machinery is actually one of the lowest numbers on the list at 2.9%. OSX hasn't quite yet seen the kind of inflationary pressures that we've seen in other markets, in part because of producer discipline in the field. And then to wrap up, just a couple of quick other points. You might be tempted to think, well, if I'm at 7% inflation, it came out of nowhere, CPI basis, and I'm seeing these double-digit numbers in PPI, surely I probably am closer to the top of the oil price movement than the bottom, particularly looking at what's happened in the past couple of days, as Mike described. There, our caution would be, remember, you got to think like a futures trader. There's not just one futures price. There's lots of futures prices, 1 month in the future, 3 months in the future, 12, 24, 60. And so revisiting this chart we've shown you before, here is a scatter diagram of realized oil price volatility in that prompt oil price, which we colloquially call the oil price, but then also plotted against here on the horizontal axis, the term structure of the NYMEX futures curve. And the punchline is that we actually have only moderately bullish kind of coordinates on where we are on the roadmap today. While it's true by some measures, we have the strongest inflation metrics in 30, 40, maybe even 50 years, which will go beyond the careers of many active participants in the market today. The truth is we've seen both higher volatility in the oil market as recently as the 1990s. That's these light green observations. And we've certainly seen stronger term structure as recently as the year 2000. So the claim that this is something unprecedented is not substantiated by the facts. And more importantly, what will happen next is we're going to get higher volatility, either if we go back towards a more bearish structure or a more bullish structure, and that will manifest as perhaps a moment to buy on the dip, as Mike just indicated. And then finally, just an update on this real asset scatter plot that we showed in September 2020 on Close of Business Tuesday. Remember, at the time, we pointed out that as of September 2020, we had seen this movement from the COVID deflationary impulse in that first January to March period, and had started to see budding pressures, both in the typical precious metal instruments at the front end of these curves, and then also in paper instruments. Here's the update: absolute explosion in Bitcoin, the clear intersection of energy, monetary policy, and inflation got to an index level as high as 904.6 on November 12th. And right now we have 5-year WTI at the highest level since these inflationary impulses began. And so putting it all together, what we find is oil is most definitely an effective hedge in an inflationary environment, usually at the front end of the forward curve. We do see benefits coming from public equities as well, less so from some of the other industrial commodities, although it is there. And of course, the topic du jour is, what does private equity do in these environments? And so with that, I'll turn it over to you, Maynard, and to Mr. Howard Newman.
Look, thanks so much, Colin. Thanks, Mike. I think, just sitting here, guys, you do understand why people get pretty excited about this. Howard, this will be a good segue to you, but you've got, Mike, you've talked about OPEC spare capacity moving in the course of the year down to a pretty low level. There's a lack of investment going on in oil and gas, and you have inflation, and you have something like Ukraine. So, just the tension around all this does look like a pretty good oil market. Howard, you've been watching the oil market for a long, long time, and I do think of you as the father of oil and gas private equity. I was going to say the founding father, but that'd make you sound, not as young as you are. But what do you look at this screen? What do you think? And first of all, let me thank you for prompting the question on inflation and oil, because that was a lot of fun to look at.
Yeah, the inflation oil has been on my mind. I looked at this over the entire period, which Colin looked at it, and I've been working since 1974, and I went to college in 1965. So in my adult life, the dollar has lost 90% of its value. So inflation is something which we really have to worry about if you're young in this world. It comes and it doesn't go away. I mean, in the 70s, I think we lost about 60% of that value in that very short period of time. But it can have major, shifts in income and wealth, because people don't anticipate that kind of decline over a long period of time. So it's a pretty scary thing, and I'm hoping that the monetary authorities take their responsibility seriously. Although history is they're always late on this stuff, and if they're late, we're likely to have more inflation in the short run than we want. That's with Colin's structure. That's good for commodity prices in the short run. It is probably bad for commodity prices in the long run, because it'll draw too much capital in to solve the problem. As we see all the time, I think that's Jeff Curry's fundamental thesis, right? That the investment cycles drive the commodity cycles. And we're in this strange world today where for now 3 or 4 years, all of the people who've traditionally financed the institutions who finance the oil market, they're gone. Right? They've just decided they don't want anything to do with it. They want out. They're going to rely on the industry to provide its own capital. And at the same time, they're going to ask the industry to return capital to them so they can redeploy it. So I think that does set up a period where there's going to be underinvestment in the commodity in that sense, which will lead to a period of supply tightening in the intermediate term, at which point in time things will reverse, right? And then the capital will flow back in and the cycle will reassert itself. I think what I see amongst our peers is everybody's out of the find it business, right? We're all done with finding oil. I mean, I started this investing at Warburg in the late 80s when the world was short prospects, and the oil price had a premium in it to reflect the cost of exploration. So you could actually finance your dry holes with your commodities, right? Today, we know where all the oil is, or we know where enough of the oil is. So that reward for finding is gone. And so people aren't going to be exploring anymore, and they'll be drilling through their inventory. And if they don't spend the money to replenish it, we'll be short inventory in a few years. The cycle will reassert itself, and then we'll be back in a period where capital will flow back in, probably from different people than the last go around. Because I think the green overlay is not going to be reversed, no matter what bobs you've seen there from BlackRock. The people are going to continue to allocate their assets away from it. Institutions are very slow in responding to these things. So it'll set up a period, I think, where for the companies which have decent production today and which are unlevered, they'll be able to take advantage of it. They'll be deploying their capital to grow and reinvest. The rest of the world, I think, is just going to stand on the sidelines.
A couple of questions come up a lot when we're visiting with industry players. One is, when does the equity market realize that these companies do have a terminal value or have a much longer life than they seem to be credited with? And it's sort of a related question, which is, when do the long onlys, when does the high quality money, when does it really come back to the space? You were sort of touching on, if this goes on, and BlackRock is already kind of sort of signaling this, if this goes on, money will come back. So do you think that means we get a revaluation of oil and gas companies in a couple of years? Or how do you square all that?
Maynard, it's a really good question. And as you know from our many conversations, private equity investors have a time frame which is very different than public market investors. So it's always dangerous to ask a private market guy what the public markets are going to do, because we're always wrong in that regard.
Well, I think of you as a hybrid, Howard, because you've been on almost 20 public boards, so you've seen this one coming and going.
Yeah, more going, I think, than coming, right? But I think, you look at your long-only investors, they fundamentally view the stocks as financial assets and not as real assets. I think so. Their time horizon is so short that it's difficult to understand how they will factor long-term trends into their thought process. I think is the way I would think about the energy markets. And you can't see you look at the way the energy stock went down and then went back up. You knew when oil prices were at $20 and $40 and negative $10 that was not sustainable. Okay? And you should have been buyers of public equities in that time period, right? And everybody was a seller. So and then today people are chasing and will be chasing those public equities up because they look at the past and the past is really good. So they will, I think, be forced to chase the stocks up. So in terms of how that plays out over an intermediate term period, I would say your guys are much better at figuring out that than I'll ever be. If you ask them what the private money is doing, the private money today has been pretty pragmatic. They recognize that there's no capital from our providers for growing the energy business. What our industry needed was capital to provide liquidity to those people who wanted out of the business. And probably the most attractive private market opportunity was to provide liquidity to people who wanted out for strategic reasons. And I think that's where private equity is now focused, is to buy production and get the upside for free. And to the extent that they then are able to convince their funders to redeploy that cash flow into developing those assets, the returns become really good. And I think that's where our industry is now focused. So they have, in fact, a longer term perspective, which says that oil prices will be where they need to be to elicit the supplies we need to supply the world's oil. And that the prices will oscillate around that, and they'll just invest on that mean price.
Are you struck, Howard? And I think one thing that's fascinating about your background is two of the pillars of your focus have been energy and financial services. So you're very in tune with capital flows. I guess one irony is this week is NAPE. There's 400 exhibitors. There's 50, I think, media people here. There's almost 10,000 participants. They don't have the total number yet, but it seems like a great time to be investing. What do you make of the way private capital seems to be, like the private rig count is surging, the publics are staying disciplined. Can that kind of divergence hold, or the communities seem to be getting pretty different in how they approach what's going on right now?
I think it could converge because their capital sources have such different requirements. The public market investors are now asking oil companies to compete with other cash generative businesses. And so they will, for some period of time, continue to force the public companies to behave rationally, which is good, right? I mean, in a business which is growing 5% a year and you're earning 10% on your capital, you ought to be returning capital. And I think that discipline will be there. The private market people have a different horizon. They are investing really, I think, in the expectation that they'll be in these assets for a long period of time. So they will do things where the cash flow returns merit that kind of holding period and be paid for that illiquidity. And so they may be actually operating against different metrics. Whether the heyday of the private equity business, where you could put sticks on a map and sell it to somebody who had more capital than they needed, will ever come back, I suspect not for a long period of time. That people will not value your inventory, which is, that was the private boom, as it were, during the development of the shale business, was to create inventory and sell it to somebody who wanted to drill it. And more importantly, was you're selling it to somebody who got paid for accumulating inventory. Today, you see everything which is trading, you're getting paid your production value. Your inventory has no value to people because the assumption is you're not going to drill it. So the private market, I think, is going to step into that void, which in many ways is what the business was like when we first did it in the 90s, in the 80s, was you got paid for your production, you didn't get paid for your inventory. And so you spent your life drilling up your inventory and turning it into cash. So what will happen, I think, is you'll see that the wealth of the families of this world who are driven by cash and cash flows, they will be in this business. They will provide the capital needed to drill it, and they'll provide the time period to enable people to reinvest that cash flow to build cash flows. So I think that's what will happen on the private side. On the public side, as I said, the public market just marches to a different drum in that sense, and they'll tend to be reactive rather than proactive.
So Howard, I was just thinking, you look at the portfolio of E&P companies that you were involved in, Bill Barrett, Newfield, Spinnaker, Cosmos. You saw a lot of flavors. And I guess one thing that was always striking about the Warburg business model is you guys would do stuff internationally, right? And so one of the things that we talk about is in 3, 4, 5 years, do you, as U.S. inventory, maybe the U.S. is a little harder to operate in. Maybe our inventory we're starting to get some visibility. I don't know. Do we start going international again for various reasons? Could you imagine that as a trend, given your background in those markets?
That's a good question. The international market is a difficult market for small people. In that sense, I guess it will depend on whether there's a perception for the need to find new hydrocarbons and scale, and whether it could be done at a cost which is possible for smaller companies. So it's kind of not much of an answer, but
no, it's
in the
hard.
short run, no. In the long run, depends.
And a good friend was telling me, I believe there was some city research out this week that was talking about Exxon, Chevron, and Conoco having 50 plus years of inventory in the Permian. I know that's a big debate and on what those numbers are, but if that's true, then that points you to some different answers around leaving the U.S. for more production.
There's lots of oil out there. We know that. We know it's very price dependent. I mean, there's a lot more inventory at $75 or $80 than there is at $40 or $50. And I think most people are running their exploration models on $50 oil. Once they run it on $70 oil, the universe expands dramatically.
You've seen so many, I mentioned it, over 45 boards, I believe. You've seen so many teams, private and public. And leadership is such a key component of any investment. You guys that's always been a big thing with you. As you think back on leaders and good CEOs and good governance, we had teed you up to talk a little bit about what are some key things you've observed over the years looking at all those management teams.
The thing about a good CEO in this business is they think financially rather than geologically. I think that they look at a well or a prospect and they think of it in terms of rate of return against oil price and finding cost rather than how much oil they can find in a given prospect. So they start the business having respect for and discipline of capital, and they're able to manage their geos and their engineers accordingly. I think that when I look back over the people who've been successful, that's what's driven it. They recognize that the energy business is all about the capital more than it's about the reserves. And once you drill an oil well, you know that that's the maximum value of that oil well. Right? It's just going to deplete and get less valuable over time. So if you get mesmerized by the romance of the drill bit, you'll take your eye off the ball that it's all about converting dollars into more dollars. And I think the successful people have been focused on that. They understand that the drill bit and the exploration business are means to an end rather than just an end.
So you did reference Joe Foster, for those who might not have gotten that. When I think back to some of my experiences with Joe, or my impressions is, they had meetings where everybody was in the room, information flowed freely, there was a culture around it, which was teamwork and performance-based, and the incentives were correct so that the whole organization was all in to perform. What are some of those types of things that tend to go with not just good leadership?
So here's what's remarkable about Newfield is during the first 5 years, I think they got rid of more than a third of their founding employees. Because as you said, it was a performance culture. It was very matter of fact. It was very non-emotional, but it was very disciplined. But that's not the only way to success. I mean, I look at Spinnaker with Roger Jarvis. In the 6 or 7 years we were there, they only had 2 people out of 65 who left. They were both very successful businesses, okay? They were both performance cultures, but they had a very different mindset about the ways to deal with their people. Both of them were organizations that created tremendous respect in their organization, but the organizations responded very differently to that. So it's hard to say that there's a one-size-fits-all on that organization, and you go through the other companies you talked about. Some of those teams were very long-lived, some were very short-lived. But I think what in fact was common for the people who succeeded is they understood the discipline which the financial markets should provide, and they embraced it. They drove it through their organization. Funny thing about, let me continue a little bit with Newfield. The story of the Newfield founding, what do they call it today? The foundation myth, right? Was I had met Joe when I was at Morgan Stanley. He wouldn't remember that. And then I was introduced to him by Mike McMahon when Joe wanted to buy Tenneco Oil and Gas from Tenneco. And they put together an LBO model, which in effect relied on oil prices increasing at some large number. And the model was to borrow money with zero coupon bonds at 12%, and then eventually earn your way out of it. And Joe kind of looked at this and said, let me see if I understand. I have to borrow money at 12% to reinvest it at 10%. So where's my leverage in that? And I think so Joe instinctively understood the finance aspect of it. And then when he came to market, financed by Charles Duncan and University of Texas, and they came with more of a drilling fund structure. And we just weren't going to do a drilling fund structure at Warburg. I joined Warburg, and one of my first jobs was to dig them out of a deal they had done in 1980, which is a drilling fund structure, which just didn't work. And it didn't work because the incentives were wrong, right? The operator was getting paid royalty interest. He was getting paid before I was getting paid. And Joe and I spent the better part of a year trying to convince him that we could reproduce his economics in a corporate structure. And eventually, since there was no other capital available, important part of the story, Joe and David said, yeah, we could do that. And we restructured the existing ownership arrangements. The existing investors, particularly led by Charles Duncan, were understood that their deal was too good. They had to give some back. And we created a business where everybody was getting paid at the same time. And we all had the same time frame, which is the hardest part of a business, right? And Joe was able to drive that culture through his business. And so was Roger, and so were the people at Cosmos. That was the key thing, was to get that identity of interest, which for a public company is really hard. Why is that? Your employees get paid on an annual bonus cycle. So they have an annual program, right? Your investors have a quarterly focus, and you're investing in assets which have a 5 or 10 year horizon. So in a public context, that's really hard. In a private context, you can get those timeframes more coincident. And I think having a management team that wants to do that and then buys into the congruity of everybody's goals, that's what drives those things to be successful.
One thing you mentioned, Spinnaker, that was it was an interesting situation because you had a partnership with PGS, as I recall, and they contributed seismic, and so there was a sense that they had a higher probability of success, more inventory. The company got a really strong valuation. Do you think, I suppose it's related to will the long onlys come back, and will people realize there's a terminal value or more than they give us? Just wondering, do you think people will value inventory again? That type of psychology, we're going to have a view that the world is short oil, or could potentially be, I suppose, to get those kind of valuations again.
I think you're right. You'll need to see value in the inventory. Today, people have all the inventory they need. And so they will acquire additional inventory, but they end up paying for it. I mean, if they're public markets, they're only allowed to bring 5 years of drilling into their reports anyway. So if you add inventory, which is going to be drilled in years 10 to 15, it's not helpful in any way, shape, or form. It was very helpful during the boom, right? When we were developing the unconventional resource, people were paying for inventory, and they were happy to add 20 and 30 and 40 years of inventory. But I think the world has figured out we don't need 40. You're not going to get paid for 40 years of inventory. It's like a coal business. I mean, all the coal companies have hundreds of years of inventory, right? And they get valued on a multiple cash flow.
You look at some of the issues we've been debating, valuation, capital flows into the sector, public versus private, U.S. inventory, international, all these things. And I haven't even mentioned the energy transition. How does a board in a classic energy company try to create a framework for a 8 to 10 year, a longer term planning horizon? It seems so difficult right now. What they're doing is even harder than what the investors are trying to do.
It's daunting. I agree with you, because they have to ask themselves over what period of time they're trying to maximize value. And are they building something which can have a perpetual life, or are they building something to be acquired? It's easier to have that dual track when you're private than when you're public. In your public, I think you have to be always assuming that you're building for perpetuity. That raises the really important question you did, which how do you think about the energy transition? If you're an energy company, I mean, you know that the world is going to come to a solution on carbon. They just have to, whether or not carbon dioxide is caused by human beings or not, whether it's causing global warming is besides the point. The world is acting as though it will. The evidence supports that, but there's no reason why we shouldn't take the carbon dioxide out of the air if we can. And we can. And we've seen in the past 30 years, most people don't realize this. We've seen the amount of carbon molecules released per dollar global GDP go down by 60%. And there's nothing which is going to slow that trend down. Certainly in the West, nothing will turn it down. And in the developing world, they too will get to the point in time where they can invest in that conservation. I mean, the energy inefficiency of the developing world is large, right? I mean, the US is at 5,000 or 6,000 BTUs per dollar of GDP. The developing world's at 12 to 15. So as they get richer, they'll begin to ride that curve down as well. And they will get to the point like the US has, where we can grow without increasing our carbon footprint, or like Europe, where you can grow and decrease it. And so I think that the assumption will be that the world is going to have to solve this problem. And you as an energy provider have to be prepared for that. What does that mean? It doesn't mean that hydrocarbons are going to fall off the cliff in 2 or 3 years, 5 years. I mean, even in the US, I mean, we have close to 300 million vehicles on the road. Right? And we're selling 15 to 20 million a year. How long is it going to take to get that gas guzzling fleet off the road? It's just going to take a while, but it's going to happen. And so I'll let you interrupt me. It's okay. But you as a board, you have to understand that, you don't want to make investments with a 30-year horizon anymore. It's got to be truncated. And you've got to be prepared to survive in the transition. You got to lean into it rather than oppose it.
Yeah, just a couple points to be made on that. I mean, you asked. I mean, I was listening to BP call today, and it was really interesting because they don't expect prices to really implode, through this transition. They talked about $60 oil in 2030, and the other thing they talked about, which I thought was interesting, to answer your question on reserve life, they talked about 8 years being what they want to have on hand in general. So that kind of gives you a data point of how they're thinking about things, and it goes into what Howard just said. Maybe that's the right number. 8 to 10 year reserve life is probably the right thing. First of all, the question I have for you, kind of to change direction here, is more on LNG, natural gas. We saw an article that you were part of the Wall Street Journal maybe about 2 years ago, and you talked about fracking for export was the title. And back there, what was interesting to me is that back there, the U.S. market was a little smaller than it is today. I think the export market as of last month was maybe 12.5 to 13 Bs. We're probably going to be there for a while, but we are now the biggest LNG exporter in the world. We weren't there a couple years ago, and probably in the next year we won't. We'll be lower than maybe Qatar and some other areas. But the interesting thing to me is you said that the biggest issue for the U.S. is not the price or anything like that. It's just getting it to market. It was a transport issue as opposed to anything else. And maybe kind of give some thoughts on that, because we know, like Senator Warren just a little while ago was talking about, well, LNG is we shouldn't export it because prices, the prices we're getting overseas are much more. We got to keep it home. What are your thoughts now, 2 years later, on that?
Well, I was delighted that I was a stopped clock and the world has come around to where I was.
Well, Howard, you'll laugh. We, speaking of getting it right, we've got an article from Colin Finton from 2011 that says, "Can U.S. gas save the world?" So you guys are kindred spirits.
Look, there's more gas than we know what to do with in the U.S. We know that, and then there's more gas than we know what to do with globally. We know that as well, and the challenge is getting it from the field to the market. That's as much politics as economics. I think we were lucky. We went through a period of time when the politics was benign, right? In the last administration, they were not going to do anything to impede this. We have an administration now which is inconsistent in its approach to these things, right? I mean, it comes in and the very first things it does is it shuts down imports from Canada and turns off leasing, and then a year later it asks the Saudis and the Russians to produce more oil. I mean, and now it wants the Middle East to supply Europe with gas, right? I mean, the political overlay on the business is just so disruptive. It's hard to know whether the right thing is going to turn out. We have the opportunity in the U.S. to provide much more gas to Europe. We have the opportunity to provide it with much more secure gas. Okay. That'll require the administration to stand up to the environmental lobby, which is opposed to it. And whether this administration or the next administration will be able to do that is a question which the people on this call are all better qualified than I am to guess. But that's what will depend. I mean, you've seen people continuing to add to their export capacity. But whether they will be able to satisfy that is going to then be a function of the domestic political agenda. We should do it. There's no doubt about that. I mean, the strangest thing, the person who should have done it 15 years ago was the Iranians. The Iranians should have traded their nuclear program for a guaranteed 25% of the European oil market, right? Gas market. You know, they have the world's largest undeveloped gas field, right? So why don't, and just standing there. So, and people allow their political and others' agendas just to interfere with what they should be doing rationally from an economic perspective. I said the past 4 years, the U.S. was lucky. We developed a huge amount of export capacity. The industry provided the impetus by that by overproducing domestically, driving the price of gas down. The only thing to do with it was to sell it abroad. So by allowing the markets to work, we got to a good answer. Whether we'll allow the markets to work again in the next 2 years or 6 years that's a call I can't make.
Yeah, the interesting thing too, Howard, is we're now finding out it's not a decarbonization issue. It's also a political issue. It's also a military type issue. It's a security risk issue. You know, obviously what's going on in Ukraine. So it would seem that you would have some more momentum based on that. And I know from the article you basically were quoted, and your big point too was that if we really want to get carbon out of this world, we have to basically have China stop burning coal, and this would solve it. And so we could check off 3 boxes here by doing something like that.
I mean, half the world's carbon comes from coal, and half of that comes from China. Right? So why are we exporting gas to China? I mean, we could take 5 gigatons out of the air in 2 years. No trouble at all. I mean, it was telling that at the end of the Glasgow conference, the very last day, the Chinese and the Indians backed off from the break the world wanted to put on coal. It wasn't hard to see that coming if you understood how important coal generation was to their economies and the low price at which coal was consumed. So if you want to decarbonize, you got to solve that problem. You got to get those countries to get rid of their coal and burn natural gas. And in India, they still have in their mind that old debacle from the Enron deal, right? When they I guess it was, they were building an electric facility there, and then the price of gas went up and their economics all went down in a handbasket. They'll need some contractual protection, as it were, against gas prices running away from them. And what you find, what I've observed here, talking to the people in the LNG business, the buyers are on both sides of that equation. On the one hand, they don't want to commit long-term because they've seen prices go down and down and down. But on the other hand, they need to commit long-term in order to get the supplies. And then the producers turn out to be exactly on the opposite side of that equation, right? They want to get the advantage on the upside without providing protection on the downside. So I think ultimately there's enough people that own gas reserves that if there were no political overlay, people would solve this problem in a constructive way. And you've seen the U.S. develop its natural gas resource for export in that way. Hopefully it'll continue.
What you just said, Howard, was really powerful. If there were just no political overlay, we could solve this. Most people think government has to get in to solve this. Government is arguably getting in the way of solving this.
If you look at what the government has done in the natural gas industry, I'm going to get on my soapbox here for a minute. Every call they've made in the 50 years I've been in business has been wrong, right? I mean, I started when gas was like 22 cents an MCF, by the FPC, remember that? And then we got to the 70s and they took it up to 50 cents. And we were going to build this pipeline from Alaska to bring the gas in, and the government interfered with it. Next thing we knew, we ran out of gas in Ohio. So we put in price controls, new oil and old oil, and we forbid people to build new gas-fired power generation. Do you remember that? And then within 4 years, we were flooded with gas. And so then we required people to build gas-fired generation. I mean, we're always solving the wrong problem. And it goes on and on and on, even through today, right? With I said, the first thing this administration does is it interferes with the import of hydrocarbons from Canada, and then we run out of hydrocarbons and price goes up, and we try to reverse it. If they just let the capital markets and the entrepreneurs provide it, I know I sound much more right wing here than I am. It'll be fine. It'll be fine.
So Howard, on that point, turning to that nature-based systems, that question of an open-minded, pragmatic approach. When you looked at nature-based systems, you didn't look at a public company, you didn't look at a private company. You found a nonprofit, Salk Institute. Now, albeit it's one of the top nonprofits in the world and has just absolute geniuses roaming the halls. Can you tell us a little bit about what you saw in the Salk Institute that grabbed your attention? Are there any private companies that are now on your radar screen implementing nature-based solutions? And how do you see it fitting into the energy and environment question?
Okay, thank you. It's a good question. So the history is a little different. I had been on the board of the Salk before I got involved in the nature-based solutions. That I joined the Salk board in 2003 and got to know their biologists. And the origin story here is that I was riding with Joanne Corey, who's the senior scientist, and she was talking about how as the world warmed, all of the places we grew crops today would no longer be suitable. And that, like, for example, if it gets above 88 degrees, corn doesn't ripen, right? So you're going to have to develop corn crops which are farther north. And if you go farther north, the light has changed. And if the light has changed, you need new genes and so forth and so on. She was focused all of her life on trying to use her expertise to help understand how to have plants adapt to a warming world. And I gave a presentation to one of our investors a year or so later, where I came across the insight that it's not that the humans are the sole cause of there being too much emissions in this world. It's that the Earth emits a lot of emissions as well. I think you've seen the data that we think about humans emitting now close to 40 gigatons a year and the Earth absorbing close to 20. So there's a 20 gigaton imbalance. And we're trying to get humans to reduce their emissions by 50%. And we're just unsuccessful. But I noticed that 20 gigatons that the Earth absorbs a net number, right? The Earth actually absorbs 750 gigatons, 747, and releases 730. So I went to the Salk scientists and asked them if they couldn't work on one of those two numbers. And they rapidly decided they weren't going to try to make photosynthesis more important or more efficient. Nature spent 500 million years doing that. But that nature had never addressed the problem about how to get plants to not decompose. And humans had never addressed the issue about how to get plants to not decompose. So they were able to turn their understanding of genetics quickly to the task of identifying ways to get plants to not decompose. And we're in the oil business. We know why plants decompose. They get buried at a place where there's nothing to eat them, largely. And sometimes they get buried in a form which the bugs can't eat. And I know that the Salk people came and talked to you guys about that before. And so they set about finding ways to make plants do that better. And the difference between the Salk's approach to nature-based solutions and most other approaches is Salk started out with what we in the energy business would refer to as a full cycle approach. They looked at when it grows and when it dies, whereas most other nature-based solutions are based on adding to the biomass. The Trillion Tree Project is adding to the biomass. And if your perspective is more than 5 or 10 years, you recognize that doesn't really work because those plants then die and begin to decompose. So the insight to the Salk was to focus on the full cycle and, more importantly, to work on the back end than the front end. So that's how that all got started. And I think my first suggestion to them actually was that they should figure out how to get coral to grow in a wider horizon. Coral grows in 78 to 82 degree water, and coral's all carbonates and oil and gas based in it. And they looked at me and said, "That's a great idea, Howard, but coral's an animal and we're plant biologists." So they didn't really want to work on that solution. So they came up with a better solution, which was, deep roots, big roots with suberin in them. There are today, and the problem in that approach is to be able to demonstrate that you're putting stuff into the ground and it's going to stay there. So the issues of additionality and permanence are the issues which we're now focused on at the Salk. We haven't found anybody, to now answer your question, who's focused on this issue as well. We've begun to see some people call us up and say, we'd like to figure out how to grow plants in arid areas, for example. Can we come talk to your geneticist about how to do that? So I think there's beginning to be some understanding of the power of biology to actually serve as a very, very low-cost carbon sink. I think when the Salk people visited, they talked about doing it with row crops and cover crops, the need to do it with grasslands and wetlands, the need to restore wetlands. These are all, in my judgment, low-hanging fruit for ways to bury large amounts of carbon, 5, 10 plus gigatons a year at a cost which is affordable, order of magnitude $10 a ton. And I think we're making good progress on that, and we're looking for other people to get involved in that. We haven't yet found private capital who's doing it because the science is still premature. But I can tell you guys, I think when Dave Lawrence and the team were with you, they said they're getting to the point where they're going to be out looking to bring private capital to bear to help commercialize this. Dave Lawrence is now signed up as the executive director of the Salk Harnessing Plants Initiative. Dave, many of you know from his days at Shell, is a world-class businessman and a world-class geologist, and he's now a world-class plant biologist. But our needs here, and I think our program over the next 2 or 3 years, is to finish the science. And I think we're making good progress at figuring out the genetic basis for putting this in plants. The next step of this, for all of those of you who are philanthropic, is to address the permanence issues at the plant level. So there's some work involving the bionome and things like that to demonstrate that the stuff stays there. At the same time, we've begun the process of moving the plants from the lab to the greenhouse and from the greenhouse to the field. And we're going to do that, I think, in a commercial way, set up a new organization, which we have affectionately called ScaleCo, as opposed to NewCo, called ScaleCo, to differentiate it, to make that happen. And then ScaleCo's job will be to finish the translation from the lab to thing. The analogy Maynard gave me was it's like a prospect generating shop, which I think it is in many ways. And then to find individuals who want to take plants, crops, wetlands, whatever it is, with our science and develop businesses around that. So a business model, 2 business models. One is a commercially successful Bell Labs, as it were, or commercially oriented Xerox Office Park. And then the second is capital, which wants to finance individual ideas coming out of that. And I think the Salk is now at the point where it's going to begin to look for that kind of capital. And we're hoping that there will be large numbers of people who decide to do that as well. As I said, some people have called us up. Some guys with venture capital experience have said, can we come talk to you about ideas we have in this? And I think that's what's going to happen. We should see some motion in that in the next couple of years. Pretty excited about it. Willing to talk to anybody who wants to be part of this journey with us. There will be, we'll send them all to Dave. Dave has now got the job to be the clearinghouse for this. Pretty exciting stuff. And the potential for it, it's not going to solve all the problems overnight, but if people begin to understand the power that biology can have for this, we can rebuild the wetlands, we can provide protection to Louisiana, we can restore the feeding grounds for the fish. That's just one part of it. We can use the existing agricultural distribution system to scale at a very low price. I mean, a $10 to $15 per ton is more money to the farmers in the crop support system. So you can really repurpose that money. And then there are people who recognize that there's going to be a carbon price and they have to remediate. And the nice thing is you don't need $200 a ton to do this. You can do it at a price which is affordable for the world. And I think that's the real key for it, is you need a solution which is affordable not for the US and not for the EU, but for the rest of the world. The US can now afford to solve this problem. It could take a $100 carbon price and not damage the economy. That's not true for China. That's not true for India. And I don't know, quite frankly, whether a $100 carbon price would change enough behavior to be meaningful. You might need a much larger number. But if you can have a solution which takes place when you're asleep, it'll be good. The other nature-based solutions, all the nature-based solutions have the same problem, which is we need a carbon price. We need a carbon price. And the voluntary market today is providing the cheap stuff. It's providing trees. I mean, Shell will plant a tree for you if you buy gas in Europe, right? So you can't, and trees are cheap. We got it, but they're not going to do the job. We need something which deals on a more permanent basis than the forest walls will.
Well, Howard, there's only one problem with having you on, which is we love talking to you too much and we can think of too many things to ask you. But we probably ought to wrap up, as much fun as we're having. I was thinking, in our experience with COBT, that Salk show and that was probably as eye-opening as any discussion we had about a potential solution. And who knows, maybe nature-based with some of that Salk thinking, plus all these E&P cash flows that are coming, maybe there's a marriage to be had there. But
I would think so. I mean, the oil companies, they're going to solve the problem. They're going to solve the carbon problem if the politicians will let them. They're the people with the expertise. They're the people with the money. They're the people with the need. And they'll be involved in, they are involved, that. They're involved in all this stuff. They're doing sensible stuff. They're doing not sensible stuff. They will have to learn how to sequester at source. But sequestering at source only works where you have concentrated source. You are always going to need a solution which sequesters after use. And I vote against direct air capture. It just doesn't make any sense. I vote for biology as a solution. There will be lots of biological solutions, I think.
Well, as we wrap up, we need to we got to ask you our one of our key questions. It's such a good question, we put it on a mug, which is, what does the energy world look like in 10 years? We can't think of a person we'd rather hear their answer than you. What do you think, Howard? What does all this look like in 10 years?
So in 10 years, you will still have tremendous demand for hydrocarbons. You know that we won't have enough technology change to eliminate the need for hydrocarbons in 10 years. We will be on the way to dramatically reducing the need for hydrocarbons and replacing with other energy sources. But the history of humanity is the more energy you burn per capita, the richer people are. So I think we will continue to look for ways to increase the energy intensivity of the world in an efficient way. The hydrocarbons will be an important part of that solution, but we will be in the transition to balancing, as it were, the sources a little bit more towards renewables than we have today. To get all the hydrocarbons out, you got to electrify the entire world. It's just not going to happen in 10 years, and we have to do new industrial processes. So I think we'll see continued move towards the energy companies transitioning to generating other forms of energy, and the majors are leading that effort. Or I guess they're no longer called majors, the super majors are leading that effort. That'll be an important part of it. But we're going to need interruptibles. We're going to need hydrocarbons, and we're going to need them in large scale for a long period of time. So I think that'll happen. The industry is likely to be more concentrated because of that. It'll be entering a maturing phase, and the capital disciplines will require the industry to continue to consolidate. There will be wonderful opportunities for private people to own assets which are in liquidation. And you'll be able to buy them at attractive prices and turn them into bond substitutes, and that'll work fine. So those are kind of some thoughts. It's not going to go away. It'll be different. And there will always be need for the entrepreneurial spirit, which this industry has, to come up with new ideas and new ways of thinking about it. And I see them every day. People come in with yet another new way to produce energy or a new way to conserve energy. So I think that's what will happen. So you'll still have a business in 10 years. It'll just be more challenging because the need to adapt, I think, will come at us quicker.
So one thing, Howard, I just think this is a cheeky expression. I just thought of it, but I think you would appreciate it. Is that says if you can't solve a problem, redefine it. And if you replay the last few months, Europe has said actually natural gas and nuclear, those count now. And then BlackRock, not to be cheeky, but they said, well, actually, maybe you can invest in oil and gas that's getting cleaner and so on and so forth. So much of this is a disagreement about timing and how much time we have to solve these problems. Do you think it's possible that once we realize how daunting it is to change rapidly, we redefine the problem and say, actually, we have more time than we thought on second thought? Is that possible?
I think that's likely to happen. I think when I talked to you last week, I said, my prediction is we will have a carbon tax when we have a Republican administration, because we can afford a low carbon tax now. And we can take the issue off the table and provide the incentive which people need to have a carbon solution. I think in that sense, I think that'll be the first step. The second step, as you point out, is we will then buy ourselves some time. And that's the environmental lobby would argue that's too risky. That there are some models which say you have less time. There are other models which say you have more time. I think we don't need to address that issue. I think we can put in place a sensible scheme to allow the industry to solve the problem for us. And I think they'll make a lot faster progress than people think if they're allowed to do it. I mean, you get people today who don't want the energy companies to be involved in the solution. I mean, that's just crazy, right? The energy companies have the expertise, the desire. I mean, you talk about communality of interest, right? They have the expertise, they have the money, they have the need, right? They'll solve the problem. You let them solve the problem.
We are with you on that one. Well, as we wrap up, I just want to do three things that are on my mind. Number one, Mark Viviano said thanks and sent us, and good luck. He sent us Shoe Dog. So Mark, we're going to read the book. Thank you. The second thing I want to do is I happen to notice tomorrow is Harriet Foster's birthday, Joe's wife. And so since Joe came up today, we're going to, Harriet, happy birthday. We're out here and we care about you so much, and we're going to send you today's episode, which talked a little bit about Joe. And then, of course, the third thing, Howard, is just to say thank you. We've enjoyed you forever, and we appreciate your creative thinking and how you challenge all of us, and appreciate all you've done in the industry. So it's great to have you.
Thank you, and thank you for the invitation. Give a man a platform and he'll take it.
Thank you, Howard, and thanks, everybody.